G'day guys, and welcome to another YouTube lesson. Today we're going to be taking a look at finance, and the source of finance and the cost of finance, but also how getting the right finance will have either a very positive influence on a business or potentially be the end of a business, a very negative influence and impact upon a business. Now, finance is a major contributing factor and a major influence on a small to medium enterprise. Finance is having the money to be able to set up, effectively run a business. Without cheap, reliable finance, it's very difficult to start up a business and to persist with a business. Now there's two main types of finance that we look at. They are internal finance. These include things like capital, your own savings, and retained profit, which is profit the business has reinvested, the net profit they've reinvested back into the business. So that's one type of our finance. The other type of finance is external finance, which can then again be divided into two main sections. So when we look at sources of finance, that's where you get your funds from, where you get your cashola. It can be your own, it can be internal or external. Under internal, there's two options: your own funds you've invested, or it can be that retained profit, the net profit you've kept over from last financial year. On the other side, another source of finance is the external, from outside the business, getting money from others. Now there's two types of external source of finance. They are debt, which is getting money from a bank, a mortgage, finance company, but you're getting a loan in essence, whether that be perhaps a debenture, whether that be a mortgage, credit card, overdraft, and so on. These are the loans that you would be getting from a bank that you must pay back with interest. So that's a source, external debt financing. The other source of financing that we have is equity financing. That's again from the debt side. So we've got external, from the external side, not the debt. From the external side, you have debt or equity. We said debt was about loans. Debt equals loans. Equity is when other people purchase and invest in part of your business. They become shareholders and joint owners of your business. Okay, so that has its benefits too, has its downsides as well. You're losing ownership with equity, mentioned this before, but you don't have to pay back any interest on equity that people have put into the business. Now, gaining access to good, cheap, reliable finance is a major factor of being able to increase the chance of a business's success. That's what we're looking at this sort of topic at the moment. We're taking a look at the positive influences of finance and the negative influences of finance. So if you can get finance easily, that's relatively cheap, that you're able to pay back, and it's not burdensome, it's not going to overwhelm you and make you overcommit, then you're going to increase your chance of success. If you can't, then you'll lower those chances of success. Now, the next part under finance is looking at cost. The cost of finance will depend upon the following things: the type of finance you've got, because if you're getting equity, well, there's no real direct cost. If you're getting debt, there is. Short-term, long-term debt, the type of finance you're getting will increase or decrease the cost. The source, where you're getting your finance from, banks tend to have lower rates of interest than credit unions and other type of lending institutions, other type of NBFIs. They tend to have higher rates of interest. And the other thing that will add or reduce the cost of finance is the term. That's the length that you'll have the loan. Is it short term or long term? So to recap again, the cost of finance is important to look at because high cost of finance is going to be expensive for you, the business owner, and you're going to increase your chance of failure. Low cost of finance will increase your chance of success, but there are those three factors that can really influence whether your cost of finance is high or low. So the type of finance, again, the type of finance, is it equity or debt? Those two can have a big impact. The source of finance, where you're getting it from. We're talking about whether we're getting it from banks or NBFIs. Banks tend to be cheaper, harder to get the finance though. NBFIs, like credit unions, tend to be easier to get loans, less paperwork, but the interest rates tend to be higher because it's more risky for those lending providers. And the term short-term finance, like overdrafts, compared to long-term finances, tend to be, the short-term ones, tend to be more expensive, those rates of interest. Long-term loans tend to be cheaper like a mortgage, and therefore that's going to be beneficial. All right, guys, thank you for listening and see you next time.